Hello, everyone. This is Ted Bauman here with Clint Lee. Angela Giroux is not with us today because she's on vacation. Lucky her. Today, we're going to be talking about what's happening in the economy and the conflicting signals that are coming out of the news cycle and also out of the market. They seem to be in a bit of conflict. But before we do that, I just want to tell you that one of the things we're going to be advising you to do in this video is something that we're going to be talking about in the next issue of the Bauman Letter coming out next week. And if you want to get a hold of that letter, one thing you can do, and you can get this book, is to click on the link above my left shoulder, the iCard, or in the description below me, and that'll take you to a page where you can sign up for the Bauman Letter risk-free. You get your money back. It's a 1-year risk-free guarantee, even on the very last day. If you call and say, I don't like it, they'll give you your money back, but I don't think that'll happen. So let's talk about what's going on in the markets. Right now, the big issue, of course, is the Delta variant of COVID, which first emerged in India in December, and which is now essentially the dominant strain in most parts of the world, but certainly the United States. Here's a chart that shows the current new cases. You can see if you trace the red line across, we're as high as we were back in February, and we're still climbing. The rate of climb is more or less what it was in November, December, when we had just blistering infections. But this time, remember that this is a much more contagious version of COVID. I saw a headline today that said this is maybe the most infectious virus that has ever emerged into humanity. Now, that's creating two conflicting signs for investors. On one hand, we're seeing what looks like a bounce back in the real economy. The Friday's job report gave us 943,000 new jobs. That's almost 1 million. And there was a very strong showing in certain sectors. Here's a chart that shows leisure and hospitality and government, the two biggest gainers. Leisure and hospitality would obviously be all those places that closed down last year. They're rehiring. They keep complaining about not finding workers, but they seem to be doing it now. They're finding them at a pretty good clip. Government, I suspect, would be county and local governments that are seeing an uptick in tax revenues precisely from the resurgence in the service economy. And so they're able to go back in and start hiring people who got laid off last year. I know that's what's happening in my neighborhood.
And back to school.
And back to school. Let's not forget back to school. Yes, yes. Now, the next thing that happened is that we've seen the service economy hit a very high gauge. This is essentially this is what's like the PMI, the manufacturing index, but for services. It shows levels of activity, hiring, investment, et cetera. So it's at a very high level. In fact, higher than it's been in the last decade. So, Clint, on the one hand, it's a dire threat. We know that this is that COVID is threatening to take us back to where we were last year. Some people are saying we might, go right back to the dark ages of, late last summer. But markets don't seem to be looking at it that way, except for in certain segments. What are the threats? What are the opportunities?
Yeah, I mean, the certain areas of the market seem to be trading like they do expect consumers to retrench. Maybe, I don't think we're going to see, wide scale lockdowns, obviously, but, people can alter their behavior by staying at home. And certain asset classes are trading like we saw sort of a peak growth phase out of this recovery, and things are going to start to tail off because you've had, 10-year yields got as high as about 1.71 or 2% earlier this year, and have since pulled back. We're about 1.3% this morning. Over the weekend, we saw a lot of commodities come crashing down. I think oil right now is down about 3% as we're recording this, and a lot of that, once again, because of what's going on with the Delta variant, as you mentioned. But then you're also seeing some investors are starting to rotate back into the stay-at-home trade. So just to highlight an example of that, I mean, probably no stock personifies the stay-at-home trade more than Zoom video communications. And over the last 3 months or so, I got a chart right here. This shows you Zoom is up about 33% compared to the S&P 500, up about 6% versus, one of the big beneficiaries of the reopening and the cyclical recovery has been energy stocks. Now, the energy sector is still the best performing sector year to date, but over this time frame, energy stocks have dropped about 9%. So, that's sort of the conflicting signal. What do investors do? Do they chase?
Let me start there. And this goes to something that I've been thinking about a lot lately. And in fact, in my videos, the ones I send out to my Bauman Letter subscribers and also Profit Switch and my Friday videos, is the importance of zeroing in on shorter time frames. A lot of people get into the habit of looking over 1 or 2 or 3 year performance of a stock, but what we're seeing this year is that it's really important to disaggregate. If you look year to date, it looks one way, but if you take, say, the last 3 months, that's where the troubling signs are coming in. So tell us, I mean, is this run up in something like Zoom? It looks to me like it's pretty iffy. I mean, it's up and down, isn't it?
Yeah, I mean, you've had a nice trend over the last several months, but the thing that you have to consider is that these stocks, all the stay-at-home stocks, are still so incredibly expensive.
Yeah.
I think there's a work-from-home ETF. I was looking at some of the holdings this morning, and the average price-to-sales ratio of the holdings in that ETF is over 12 times. That's on price to sales. The S&P trades somewhere between 3 and 4 times. So you get a scenario where if you put too much into these stocks, you're at risk for a big drawdown like we saw earlier in the year. To kick off the year, a lot of the stay-at-home names, the expensive names, took a big hit because of their valuations. But then on the other hand, you've seen what's happened with energy stocks, with the rise in the Delta variant and increase in case counts. Is that cyclical reopening trade going to go back the other way? Even though those are cheaper, more value-oriented stocks where you don't have the valuation risk, you have the risk that these rising COVID case counts now pose. And I think what we were talking about, Ted, was instead of just looking at the world from a reopening or a stay-at-home trade, kind of broaden your perspective a little bit and look at just high quality dividend paying stocks. And I think that's going to be really important to look at that other component of your total return. It's not all about what the price of your stock's doing. It's also what type of income and dividends that they're paying to you. And just to illustrate this point and the focus on price appreciation, here's a chart from JP Morgan. They took and they put together by decade what the S&P 500's total return was, but then broke that down into price or capital appreciation, that's the gray area, versus dividend, the blue area. The 2010s were the second best decade ever for price appreciation in this data set. And once again, that's kind of what everyone's focusing on. But you can see there's other decades in here. When stocks start to get expensive, when you don't have that prospect for as much price appreciation, dividends start to play a critical role. You can see, especially during times like the 1960s, 1970s, how much dividends made up of total return. Now, over time, dividends on average for this entire time period are about 30% of the S&P 500's total return, but that's of the S&P 500. When you start to look at other areas of the market that are known for generating outsized dividends, that contribution to return becomes that much more important. And one area I would focus on right away, I know you'd agree with this, is on REITs. So with real estate investment trusts. And here's a chart just to illustrate this point. I took the IYR real estate ETF back 20 years and compared to the S&P 500 and broke down the total return. And this is the result you get. So the total return over this 20-year time frame for REITs on the left-hand side, this column, is about 500%. But you can see the price return component of this, the blue box, is dwarfed by the red box, the amount of dividends made up of this. And then that's compared to the S&P 500. So REITs on a total return basis crushed the S&P 500 over this time frame, even though it had a smaller price return component. That's the power of those dividends and reinvesting those dividends in terms of the impact that can make on total return. So that's where you want to start to focus on right now, especially as these uncertainties are starting to present themselves. This is something that's more durable.
Right. And I think it's important to to reinforce what we're saying here. I mean, if we go back to that chart that you showed earlier of the returns by different decades, that chart, let's look at that one again. Look at what happened in the 2000s. I mean, basically, you had the dot-com bust, right? And that led to a decline in stock values from their previous highs, which was kind of what happened in the 1990s, right? I mean, we saw all these stocks being driven up and then they fell. And the only action in town really was to try to buy into dividends. Otherwise, you would have lost money. Again, what we're seeing in the 2010s is we're seeing another decade where we've had tremendous stock price appreciation. And it's likely we could be followed up, but with another decade like the 2000s. I mean, that could happen. So what we're saying here is you got to stop thinking about whether you're going to flip back and forth between, reopening stocks and commodities and things, or growth stocks. Like there's the only two options, and you have to flip back between those two options every trading day. You got to. That's what people are doing. I think that's why we're seeing this volatility. What you need to do is to say, where are we likely to be in 2 to 3 years, and what's best for me to position myself right now with that money. So, all the signs point to the fact that eventually we will recover. And so what you want to do, I think, is to look for companies and other assets that are currently undervalued, that are being had at a discount because people are currently afraid of Delta and they're afraid of what it's going to do to the economy. You grab them at a discount, you get them now, you get a high yield on cost on them, and then you're going to beat the market over the next decade, probably. Of course, there will be some stocks that outperform over the next decade. I'm on record of saying that we're only halfway through a bull market. But over the next 2 to 3 years, I think the critical thing is going to be to find those values and find the good dividend payers. Now, here's a chart that shows asset class yields as of pretty much today. I think it was at the end of June or something. And it shows the current yield from different categories of assets. Now, on the far left, you've got emerging market debt that's denominated in dollars, but that's a hugely risky thing to do if you invest in emerging market debt, because if you have exchange rate variations, you can have serious problems. Countries like Turkey, Argentina have showed what can happen. Then you have preferred equity, which is basically a form of debt. That's a good thing. We hold preferreds in the Bauman Letter. We recommend them. But the next thing over is U.S. high yield corporate debt. And again, that's something that it's higher risk because of the possibility of default. If companies do run into issues, if interest rates rise, it could cause problems. That's very risky. The next one, the first one that really has an element of safety, is the fourth highest yielding asset class right now, and that's global REITs. Again, REITs are a special asset class. They're a company that has to pay out 90% of their taxable income as dividends. And of course, you get special tax treatment. You get 20% tax-free of those dividends and so on. There's lots of things that you can do. But REITs are not the only game in town. And that's what the next Bauman Letter is going to be talking about. You also have a way to capture the tremendous gains that you can get in certain sectors by investing in closed-end funds. And closed-end funds are essentially pools of investment money. They're kind of like mutual funds, but they're closed. You can't put more money into them once they're started. They trade like shares, but the managers, if they're good, can generate yields in the neighborhood of 7 to 8% every year. I mean, and they do this year after year after year, and they do it by growing the value of the assets they have under management and paying out an amount in the gains on their assets that is less than the growth of the gain of their underlying assets, and it's sustainable. Most good ones pay about half of what their asset price gain is. Some of them are trading at a discount to their net asset value, which means there's a very good chance that they will increase in share price as well as dividends. So you get them now, you get those 7-8% dividends. Some of them will even issue your new shares in lieu of dividends in more shares of that company. So it's an automatic reinvestment, which is what I always recommend for anybody who's not taking current income. So the message, folks, is in this period of uncertainty, we want to be investing in solid companies, dividend payers. We want to be getting income. We want to be reinvesting that income, particularly when the asset is underpriced, which is likely to happen when people are afraid of COVID. In fact, we bought a couple closed-end funds for the Bauman Letter last year at a steep discount to their net asset value, and we've beat the market substantially on those. And I'm talking about the whole market. In other words, the S&P 500, even over that big run up in 2020. So that's our message today. We think that's the thing to be doing right now. It doesn't mean there aren't other opportunities, but this is a much safer way to proceed. And the odds are that it's going to be the most profitable one over the next 12 to 24 to 36 months. Anyway, that's Ted Bauman and Clint Lee signing off. We'll talk to you again next week.